is AKASHVANI, Bengaluru. Good evening and welcome to tonight's Yuvavani. As March end is nearing, it's high time to plan investments for tax planning. So we have with us CA Pratiksha Pai and CA Sanketh Nayak as our guides today. Government has set some tax saver instruments with a goal of not only promoting investment behavior but also providing tax benefits to the citizen. Pratiksha, what are these various investment aspects and how is government helping people to utilize them?
Hi Jyoti, thank you for having me here with you today. Every investment has three aspects. First is the act of investing, the second is the earning of returns, and the third is maturity proceeds which we get at the end of these investments. So the government has set the tax saver investments in such a way that in certain of these schemes, all these three aspects are tax exempt. In certain schemes, the investing and the maturity are tax exempt, whereas only the returns are taxable. And in certain schemes, the investing and the returns are tax exempt, but only the maturity proceeds are taxable. So what I mean to say here is, the first one is EEE, which is exempt, wherein your investment is tax deductible, your returns are tax exempt, and your maturity proceeds are also tax exempt. What I mean by tax deductible is that when you invest in these schemes, that such investment amount subject to certain limits are deductible from your total income, and on the reduced income you will be paying taxes. The second is ETE, which is exempt, taxable, exempt, wherein your investment are tax deductible, the returns earned are taxable, and your maturity proceeds are tax exempt. The third one is EET, wherein your investments are tax deductible, your returns are tax exempt, and your maturity proceeds are taxable. So based on these three types, you can plan your tax investments.
Can you tell us more about the EEE schemes?
Yes, one of the most popular is EEE, wherein everything is exempt. In this, one of the most popular again is something called PPF, that is the Public Provident Fund Scheme. See, this is a long-term tax-saving investment scheme. By long-term, I mean a lock-in of 15 years from the time you begin to invest. Every year, you can invest up to 1.5 lakhs, 1.5 lakhs. And since this is an EEE scheme, when you invest, whatever amount you invest, up to 1.5 lakhs is tax deductible under Section 80C of the Income Tax Act. So to tell in simple words, if you are paying taxes at 20% and if you invest 1.5 lakhs into PPF, that means on 1.5 lakhs being tax deductible, you are saving taxes up to rupees 30,000. Which is 1.5 lakhs into 20%. Now, the beauty of this scheme is that not only the returns are tax exempt and maturity proceeds are tax exempt, but your interest is compound interest at the interest rate of 7.1%, which is the current running rate of interest. Your interest is compounded annually but computed monthly. So the hack here is that the interest is computed on the 5th of every month. Please invest in PPF before 5th so that whatever balance is there on 5th, you can get a higher interest. To tell this in numerical terms, for 15 years, if you are investing 1.5 lakhs every year, which means in 15 years, you have invested 22.5 lakhs. But your maturity proceeds will be almost 38.68 lakhs. That is the magic of compound interest. One more thing is that this is a government scheme, so it is low risk and stable returns. Also, another thing is, if in the tenure of this scheme, you want some money back, then between the 3rd year and 6th year, you can get a loan against your PPF balance up to 25% of your PPF account balance. And the beauty of it is that this loan is at just 1% rate of interest above your interest, what you earn. So now the interest rate is 7.1%. So if you take a loan, it will be 8.1%. What will happen after 15 years? You will have the option to either redeem, or you can keep the maturity proceeds in your account indefinitely, or you can even renew that for another 5 years, any number of block of 5 years.
Now, I understand that PPF has compound interest, but what do you suggest to our youngsters who have just begun earning and they are in a much better position to invest in higher risk schemes, which I'm sure would also be better returning schemes?
In today's day, there are better instruments like investments in equities, which will give us much better returns when compared to these traditional schemes. So one such scheme which is there is ELSS, which is Equity Linked Savings Scheme. So here what happens is, you don't directly invest in equities. Mutual fund houses create a scheme wherein whatever you invest up to 1.5 lakhs can be tax deductible, and that has a lock-in of 3 years. This is the shortest lock-in which is available in the tax saving instruments. And additionally, you can do this investment either in a lump sum mode or in a SIP mode, where you can do it at regular intervals as well. Normally, equity gives better returns over a longer period when compared to most of the other instruments. However, one drawback is that there is no fixed return here. The return is linked to the market. So normally, market returns are good, but in certain cases there may be certain years wherein it may not be up to the mark. Additionally, there is no sovereign backing here. So there may be rare scenarios wherein we may not get our capital back, but this has not been the general scenario. Also, it is something like an ETT kind of a scenario wherein whatever you invest is exempt. If you opt for a dividend-based scheme, then the dividend is taxable. You can even go for a growth-based scheme wherein you don't have to get any returns on a regular basis. And the maturity proceeds are taxable, but only to the extent of gain.
Is there any way in which one can invest in equity but still have some measure of safety?
One of the ways to save taxes as well as indirectly invest in equities market as well as build a retirement corpus is something called the NPS, which is the National Pension Scheme. Basically, NPS is a voluntary retirement benefit scheme by the government of India, which helps individuals to accumulate a huge corpus during their working life to avail post-retirement benefits. This is an EET scheme, which is exempt taxable. Your investment is tax deductible over and above the 1.5 lakhs which you invest in other schemes like PPF under ATC. You can get up to 50,000 worth of tax deduction under this scheme. Maturity proceeds are partly taxable after your retirement. Up to 60% you can withdraw as a lump sum of whatever balance you have, which will be tax exempt. The remaining 40 will be converted into something called annuities. In simple words, it is pension. You will monthly receive some amount. That amount will be taxable. Now let us come to the most important part, how you can indirectly invest in equities market. When you invest in NPS, this amount is further invested, maybe in low risk avenues like government bonds, or moderate risk avenues like corporate bonds, or moderate high risk like equities, or high risk avenues like real estate and infrastructure. There is an option that you can choose, which is either an automatic option or option which you manually choose. I would request that if you are young, your risk taking capabilities are higher, when you are opting in NPS, you should choose for something called auto, wherein the algorithm will choose the investment for you.
Sanketh, my next question is for you. Are there any low risk schemes besides PPF with a lower lock-in period?
There is very safe and simple instrument, which is a special kind of FD called tax saver FD. When you are, let's say you are approaching very end of the year as well, it's a very simple this one. You just need to go to the bank, any scheduled bank, private or public, you are eligible to open a tax saver FD. And you have to keep in mind that you have to specifically mention it's a tax saver FD, because if you just open a regular FD for the same tenure as well, it doesn't count. and it just has a 5-year lock-in, which is just 2 years more than the ELSS which we discussed earlier. And the returns are prescribed at the very beginning itself. This is an ETE scheme wherein the investment is exempt, the returns are taxable, and the maturity is exempt. The interest would be taxable at your slab rate. So if you are paying taxes at 20%, you will need to pay tax at 20% on the interest. There is no sovereign guarantee here as compared to PPF. However, there is one more aspect which you need to keep in mind. DICGC, which is a government-backed body, covers up to 5 lakhs of any deposits which you keep with most of the banks. 1.5 lakhs would anyways fall within this 5 lakhs. So you would be covered with some kind of government protection.
Pratiksha, would you like to tell us about any other low-risk schemes?
I would also like to mention one ETE scheme with similar lock-in period of 5 years. So one of the most underrated low-risk government-backed fixed income instrument is the NSC, which is the National Savings Certificate. The best part is the eligibility for this scheme. Any Indian, irrespective of age, can invest in this scheme. Another very good thing about this scheme is the investment limit. There is no maximum limit at all. If you have any kind of lump sum, if you have earned, any annual bonus if your company has given, and you want to put it in a low risk scheme, then NSC is the scheme for you. Only thing is that you should be okay with having it locked in for 5 years. Now you may tell that why would I put in NSC? Of course it is low risk, but there are many other low risk schemes. In NSC you also earn a compound interest. The running rate right now is 7.7%. So to tell it in numerical terms, if you invest 1 lakh in an NSC today, after 5 years you will get back around 1.4 lakhs, which is a very big return. This is an ETE scheme. The investment whatever you do, it is tax deductible up to rupees 1.5 lakh. The interest what you earn, that is taxable as income from other sources. You have to pay taxes on the accrued interest every year, but you get that interest only at the end of 5 years. The maturity proceeds, whatever you get after 5 years, that is tax exempt. One more good thing about NSC is that you can pledge this. So say you want some money, you can pledge your NSC balance and get a loan. If you have not yet opened your PPF account, the first 1 year you invest in NSC up to 1.5 lakhs and get the complete advantage of ATC deduction. From next year you start PPF, because if once you start PPF, 15 years it has to go. So from next year you start PPF and let it go for 15 years.
Sanketh, finally, are there any other schemes worth mentioning that you would like to discuss on this show?
One more scheme is insurance. Though insurance is not an investment by itself, in certain products wherein insurance can also be a type of investment, but irrespective whether the investment or not, you are still eligible to get deduction under ATC in most insurance products. Wherever the premium is 10% or lesser of the maturity amount, in such cases, you are eligible to take such premiums as a deduction under ATC. And this as well can be done up to 1.5 lakhs. And insurance products in certain cases would fall under EEE, wherein the investment would be deductible, the returns which you get will be exempt, as well as the maturity proceeds would also be exempt, as long as you satisfy that 10% ratio.
Thank you. With this, we conclude tonight's Yuvavani. We had with us CAs Pratiksha Pai and Sanketh Nayak, who discussed the salient features of various investment instruments available in our country today that offer tax benefit. This program was brought to you by AKASHVANI, Bengaluru.